everybody, and welcome to this evening's lecture. Thank you for coming out to join us on this Thursday night, and welcome to those who are joining in or will see this later. I'm Rosemary Addis. It's my great pleasure to be your moderator tonight on behalf of Melbourne Climate Futures and the Australian Academy of Social Sciences, as well as Melbourne Law School, who are hosting this. We're here, of course, for the Paul Bourke Award lecture, recognising the contributions of my colleague, Dr. Arjuna Dibley, who you'll hear from later, and I'll give more of a formal introduction. I acknowledge that we're meeting here tonight on the lands of the Wurundjeri peoples of the Kulin Nation, and I'd like to acknowledge and pay my respects for their custodianship, their stewardship of these lands over many thousands of years, and extend respect to any Aboriginal and Torres Strait Islander people who are joining us here this evening. The Paul Bourke Award for Early Career Research honours Australians in the early part of their academic career who have achieved excellence in scholarship in one or more fields of the social sciences. So it's fitting that Arj, whose work crosses between the social sciences and finance and markets, is able to share his work with us tonight in such an important area. Paul Bourke was a distinguished historian, particularly known for contributions to the field of performance measurement. And at the heart of today's discussion is a question that has real import for our time. Does sustainable finance work? Does it work to do what? What should it be doing? This is really important even more broadly as we face into the rest of a defining decade. Are we directing capital towards more sustainable solutions, towards better outcomes? Are we ultimately making the whole of our financial system more sustainable, or are we just tacking things on to business as usual? What kind of conditions do we need for capital to be an effective lever in enabling climate action, in driving the energy transition, and achieving global goals with justice and equity? The promise, of course, is that we can translate what are increasingly existential threats and risks into opportunities, and that we can create the future that we want for our children and grandchildren. That, says former Governor of the Bank of England, Mark Carney, requires a whole economy to transition. Every company, every bank, every insurer, every investor has to adjust their business models. This is a big call. We've seen a lot of movement. We've seen movement in markets, we've seen movement of capital, we've seen new solutions coming to the fore. We've seen governments now coming in with regulation, reporting and stimulatory initiatives designed to bring more capital into the markets and the work that is ahead of us. The reality is that the trillions moving so far, though, aren't yet shifting much in the real economy, complicated by some of the other things we're seeing out. The effects for people and communities continue to be profound and really unevenly distributed. Some of our current models show no sign of really being able to tackle the issues at their cause. The effects of climate change, the structural and geopolitical shifts that we face into are manifest. And the true cost of transition is becoming clearer right at the time that we're also facing tightening fiscal conditions for other reasons. You all read the papers, it's a politically potent cocktail. So tonight we're going to look at what really is happening out there. What's the state of play for sustainable finance, its role in this current context, what's happening, what needs to happen, who has the levers. So to kick us off with an introduction to this evening's lecture, it's my pleasure to introduce to you Chris Barrett. Chris and I first met, I think, in around 2007, around ambitious reform agendas, and you'll see there's a theme. His current role leading the Victorian Department of Treasury and Finance is informed by storied experience now through policy and political advisory, including global perspective at his time at the OECD, and his work on leading international strategies coalescing people around the economic and financial implications of a low carbon transition with the European Climate Foundation. So it's my pleasure to welcome Chris to give us a framing introduction for tonight's lecture. Thanks very much, Chris.
Well, thanks so much, Rosemary, and thanks for having me. I'd like to also associate myself with your acknowledgement of country, and I'd also like to congratulate Arj on his prize. I was delighted to get this invitation because it informed me that he's got his prize, and I'm really looking forward to hearing what he has to say. A couple of caveats that you probably won't be surprised to hear from me. First, I have to say this: I'm not here in my official capacity or speaking on behalf of the Victorian government, but I don't think anything that I'm going to say is necessarily at odds with where the Victorian government's at. And then secondly, I haven't been engaged in this area so much super closely on sustainable finance so much over the last 5 years. I've certainly been engaged on climate change. I've been engaged in climate change for about 20 or 25 years. I've got the scars to prove it, but I haven't been in sustainable finance that intensively in the last 5 years. So I'm looking forward to getting an update. This is going to do double duty being here tonight. But without delaying things too much before you get to hear from your actual expert, a few observations, and I was asked to reflect a little bit on sort of the early days of sustainable finance. And, you know, the really early days, I suppose, were before me, but I joined the European Climate Foundation, as Rosemary said, in 2015 from representing Australia at the OECD as ambassador there. But I'd worked on climate policy from about 2003. Some of you might be old enough to remember the National Emissions Trading Task Force, when the state governments got together and thought, okay, the federal government's decided not to do emissions trading, maybe we can do it. And we did quite a bit of work there that then turned into the Garnaut Review on climate change. And then I jumped ship in 2007 to go and work for the federal government, worked for the Treasurer at the time, Wayne Swan. That was around about when Rosemary and I came into contact. Ambitious reforms around the carbon pollution reduction scheme. We all know what happened to that. And then I was by the time the carbon tax came around, I was at the OECD, watching it from that side, also helping to introduce some of the discussions about actually linking the Australian scheme and the EU scheme. When 2014 and the end of my term at the OECD rolled around, I wanted to keep on working on climate, which for me meant staying in Europe, not coming home, unfortunately, at that point in time. And I started as the inaugural Executive Director of the Finance Program at the European Climate Foundation in early 2015. European Climate Foundation, just to explain, that is a large philanthropic foundation based in The Hague, but it funds research and advocacy around the low carbon transition. So the logic around the finance stream that it was my job to stand up at the European Climate Foundation was, I guess, part theory of change and part personal policy biography, I guess. So I'll explain it, and I hope in doing that, I'll elucidate something about the sort of bit of sustainable finance that I was involved in. The Paris conference at that stage, the Paris COP, was coming in December 2015. Climate action was obviously off track then, it remains off track today. But in particular at that juncture, we were learning just how difficult the physical pricing of carbon in markets really was. European ETS prices were in the doldrums. They've been in the doldrums forever. They're much, much higher now. But back then, the European ETS was not sending an adequate price signal out into markets. The US hadn't even tried carbon pricing. It was a complete non-starter. Canada hadn't started their carbon pricing yet. That was on the horizon, but, you know, still a way away. And Australia's had just been introduced and repealed. So, and then at the same time, there were all these signals from the private investor world, serious concerns being voiced in particular by the insurance industry and the reinsurance industry. In particular, because for them, they're caught in the jaws of it, right? They're caught on both the asset side and they're caught on the liability side. So we were hearing this from the insurers. There was this work that some of you would be familiar with Carbon Tracker as an organisation. Carbon Tracker had done this great work on the carbon bubble. For those of you not familiar with that, and I imagine if you're sitting in this lecture, very few, but this is the idea that 80% of the reserves of coal, oil and gas on private sector balance sheets was unburnable if the world was to stay under 2 degrees. And so if the world was rapidly adjusting towards a 2-degree world, taking action, the transition risk to existing balance sheets of carbon intensive businesses was really substantial, and therefore also to their share values. So the theory was a bit, well, we struggled to price the physical carbon, but could all this talk in the finance sector result in something? Could it result in a carbon premium on financial markets instead of physical markets, i.e. that emissions intensive firms could face a higher cost of capital and greener firms could face a lower one? And during 2015, there were some good straws in the wind in this regard, some of which ECF was involved in, others not. There was more good carbon tracker analysis, deepening that analysis. The Norwegian Sovereign Wealth Fund, people might recall in 2015, made a public announcement that they were going to divest from coal. And that was the really big money swinging behind a divestment movement that then was really gathering pace, particularly in Europe. And we were seeing a lot of mostly coal divestment. Oil and gas was much harder, but a lot of sort of a wave of coal divestment coming that is, of course, still ongoing. So Paris itself was a diplomatic triumph, notwithstanding that the NDCs since then have been mostly disappointing, as we know, but it was a diplomatic triumph. And in the second week of Paris, Mark Carney announced the Task Force on Climate-Related Financial Disclosure process, and finance has really been a powerful stream of climate work since then, both this kind of analytical piece around TCFD and that stream, but then also the more active piece around divestment, and then a growing community also around shareholder engagement as well. And that has only strengthened as time has gone on. I hasten to add that sustainable finance in its other definition has always been absolutely central to international climate talks, and was particularly central to the architecture, to the political architecture of Paris. And by that, I mean the development finance, the green development finance flows, the 100 billion and the north-south sort of development finance flows. So I just want to wrap this up by saying, like everything else in climate policy, sustainable finance retains the capacity to delight and to disappoint. And looking back, what it's certainly done is bring new voices to the table. And it's been very successful in doing that. Not for nothing that when the previous federal government finally got to the point of embracing net zero by 2050, how did they get there? They got there by a speech by the then Treasurer Josh Frydenberg saying, hey, private finance is telling us we need to move. So some of that kind of small p political logic behind those campaigns does retain the capacity to keep momentum. And I imagine that's what we're going to hear a fair bit about from Arj. The good thing about having large insurers, large asset managers involved, not so much the banks, because they tend to have a shorter time horizon, but the large insurers and large asset managers have much longer investment horizons. And so they are concerned and have to be concerned, and they speak up, and their voices count. And they're not the usual voices that we hear in the climate debate. And that was kind of something that was fresh in 2015 and retains a lot of impact today as well. So it's been powerful work. It's shaped real decisions, and I've seen that up close in my current role in working on decarbonisation policy within the state government. But there's so much still to do. And so I'm keen to hear how finance will continue to grow its impact in the future. And for that, though, I really need to hand over to the expert. I'll happily hand over to Arj. Thank you.
Thanks very much, Chris, and certainly your remarks remind us that this is major structural change, and we can't see it as linear geometry. There's lots of moving parts and things that need to be taken into consideration and that relate to one another. And insurance is in some sense is a whole other conversation, but a very interesting bellwether in the current markets when groups like the Allianz Institute tell us that anywhere close to 2 degrees, we have no insurance industry as we know it today. Now for the centrepiece of today's event, I'm delighted to welcome Aj to the lectern. And congratulations formally, Aj, on receiving this award and the recognition that it entails. Thanks also to the sponsors of the Paul Bourke Award, the Academy of Social Sciences in Australia. You will have read Aj's CV in the invitation for today's event, so I'm not going to take you through the detail. I'm not sure whether your attributes in common with Paul Bourke include a fine tenor voice, or dare I say, barracky for Collingwood. But he does share a distinguished early academic career as well as building of industry experience, a doctorate in the US. Certainly in my work here with the university, I've felt privileged to meet Aj and engage with his thoughtful approach and depth of intellect and rigour around academic work, and his genuine commitment to bridging what pure research can help us understand and the needs of industry to have actionable insights into what works and how. It's terrific working with Aj and colleagues, shaping up the Sustainable Finance Hub as part of Melbourne Climate Futures as a resource for education, for research, for industry and policy relevant insights and know-how. And that's some of what Aj is going to share with you now in his keynote. Welcome, Aj.
Thanks so much, Rosemary and Chris, for the warm introductions. It's hard to think of two better people to open a discussion on sustainable finance. And let me try and take Chris up on the delight side of delight and disappointment, and try and delight you all with some discussion about sustainable finance. But before I go too deep into the financial sector, some of what I'll say is quite technical, and we'll cover financial economic theory and policy. And so I think before going too deep there, I wanted to start at a bit more of a personal level. And I wanted, and perhaps somewhat unusually for a discussion on finance, I wanted you to all think about food. Think about what you ate this week. Was it healthy? Was it balanced? Did you eat junk food? Given I'm speaking at a university, my guess is that most of you had a balanced diet with balanced selection of fruits and vegetables and proteins, maybe a few unhealthy treats. You probably didn't make these choices because of a government regulation telling you what to do, but you did this in part because of information. And information is really key, is this key central concept that we'll be talking about this evening. So, concerted public health information about what is healthy and what is not healthy has been shared with many of you since you were children with good effect. We now have a very good sense of what a balanced diet entails. But it's not only information that has mattered to your food choices this week. We know from public health research that food choices that people make are related to structural issues, their income level, levels of education, their ability to physically access food, and so on. And we know from public health research that despite 3 decades of really good public health information, we're still as a nation not eating very well. So my point here is that information is clearly a necessary but insufficient condition to address public health concerns. And in this talk, I'll argue that much in the same way as we're trying to avoid the ills of a sick nation through public health information, the emerging sustainable finance regime, which we've heard a little bit from Chris and Rosemary in their introductions, is, in my view, at least, too heavily weighted on information as a mechanism of change. And the system is not yet sufficiently focused on what I'll call the structural issues. This is, how financial institutions are regulated and governed, which really matter for whether they have an effect in the real economy. And so I'll try to make some concrete suggestions on what the next phase of sustainable finance might look like. This obviously really matters for all the reasons that we heard from Chris and Rosemary. We're in the midst of sustainability crises, and too little money, as we know, is flowing towards sustainability outcomes. So if we take climate change as an example, the latest data from 2022 shows that 850 billion was spent on climate-related activities. This is, building large-scale renewable energy, building seawalls and other resilience activities. But depending on the range of estimates that you look at, that's 850 billion is great. It's a big number, but we need to be spending 6 to 9 times that per annum over the next 2 to 3 decades, and then increasing from there. And what's more is most of that public money still on the latest data is coming from public sources, so from governments, development finance institutions, and so on. And this is where sustainable finance offers a potential opportunity. The purpose of sustainable finance, as I'll describe, is really a mechanism to help draw in private financial capital from superannuation funds and banks and other sources towards sustainability objectives, and to try and bridge these climate and other sustainable financing gaps. And I guess as we head this year into the next international climate conference, which is being dubbed the Finance COP because of its focus on this issue, this seems like a good moment to be thinking about how do we make sustainable finance a bit more focused on sustainability outcomes. So with all that said, let's just start with the basics about what is sustainable finance, what does it mean, where does it come from? Because I know this is a domain full of acronyms and technical terms. So I like this definition from the European Commission. I use it because it's one that's picked up in multiple jurisdictions, including in Australia. But the European Commission basically describes sustainable finance as, and I'll quote, the process of taking environmental, social, and governance considerations, so ESG, again, an acronym I'll use a lot. So taking ESG considerations into account when making investment decisions in the financial sector, leading to more long-term investments in sustainable economic activities and projects. And I like this definition because it's clear about the process, so integration of ESG factors by financial institutions, and it's clear about the outcomes that sustainable finance is trying to achieve, which is about getting more investments into sustainable economic activities. So it's fair that if this is the definition that's being proffered, we ought to judge the effectiveness of this system based on that definition. And you heard a little bit from Chris about the kind of early days of this movement. The concept of ESG really evolved in the early 2000s. And it was a meeting of the minds between the United Nations and a group of investors. Basically, the UN brought together a series of investors to do some analysis on what effect environmental crises might have to the investment returns of long-term investors like pension funds, with the idea of galvanizing investor interest in this topic. And it was incredibly successful. It brought together investors mainly from liberal market economies, from the US, from New Zealand, from Netherlands, and so on, and brought together this group to form an organization called the UN Principles of Responsible Investment, or UNPRI, again, another acronym I will use a lot. And this group, basically set a set of principles, 6 agreed principles around ESG that any investor signatory would sign up to adhere to. And this includes things like doing ESG analysis of the firms that they're investing in, integrating that into their investment process, encouraging disclosure of ESG issues amongst firms. We'll get into what some of this means in a bit more detail in a minute. But I think at this point, it's suffice to say that this has been incredibly effective as a movement. As of today, UNPRI members account for half of the world's financial capital that's managed by financial institutions. So this is about 120 trillion US dollars, a number that's just unfathomably large. So 120 trillion is now managed by investors who agree with ESG principles and as enumerated by the PRI. And another way of highlighting the real impact that this movement has had is to look at the growth of ESG or sustainable finance regulation and policy. The latest data from the PRI suggests that as of 2024, there are over 1,000 regulations on the books of governments around the world. This is a 10-fold increase in the last 20 years. So there's a couple of reasons why this movement has been really successful to date. Firstly, I think this was brought to life through an insider strategy, bringing, large investors into the fold really early. The consequence of this, I think, has been that the focus of sustainable finance has been about how to arm investors with information and operate within the existing, what I'll call rules of the game. And it hasn't been about thinking about how effective those rules of the game are in terms of achieving sustainability outcomes. This latter approach was, I think, one that was deliberately not pursued because of the risk that it would put ESG and sustainable finance on a very political footing right at the beginning. I think it was a sensible thing to do at the time. But one of the main takeaways from my lecture tonight is that I think we're at the point now where we need to reevaluate that central theory of change and that judgment that was made 20 years ago. And second, and relatedly, part of the reason why this has been so successful is that this movement builds on top of fairly orthodox neoclassical economic theory about how financial markets should operate. And in this sense, by not challenging that, it's been a relatively easy approach to scaling this movement. And so on this second point, I'll go into a little bit more detail. Bear with me because I will talk a little bit about economic theory here. But I think this is really important and relevant to the discussion that comes next around why this information-based approach has real limitations and what we might be able to do about it. So, information has really enjoyed a privileged place in the heart of economic theory since, the seminal work I think that people would point to is Hayek's essay on the use of knowledge in society, published in 1945. And this was really a product of its time. When Hayek was writing this, there was a real contest in economics between socialist economists who argued for state control over the means of production and centralized economic decision-making, and those who advocated for more of a bottom-up approach to the allocation of resources and pricing. Hayek was obviously stridently in the latter camp, and was really of the view that more decentralized nature of markets would allow the aggregation of fragmented information across society held by countless individuals as a mechanism for properly pricing goods within society. And this was being much more efficient and effective than central planning. As liberal market economic structures became the mainstream and capital markets expanded, Hayek's sort of central idea about the importance of information and price setting, flowed through into financial economic theory too. Perhaps the most prominent place this appears in financial economics theory is in the efficient market hypothesis, pioneered by Eugene Fama. And Fama famously argues that financial markets are informationally efficient, meaning that investors acting in their own self-interests absorb information about financial assets like stocks and bonds, and this drives their buying and selling activity. And so the prices of financial assets reflect this complete information under the efficient market hypothesis. Of course, financial economists aren't blind to the fact that information does not always flow freely. They recognize that market failures arise, and most pertinently in the context of financial markets, where companies withhold information from their investors, and they may have very strong economically rational reasons for doing that. You don't often want to tell an investor if your company is performing badly. And so under this view, and to address these so-called information asymmetries, governments in liberal market economies often justify intervention in the financial markets by compelling firms to disclose information. So this is where the kind of core disclosure concept comes from, which we see in ESG and sustainable finance. So in this view of financial markets, regulatory interventions can also be justified to elicit information which poses a risk to the financial market as a whole, often referred to as a systemic risk. And these so-called systemic risks can lead to improper pricing of specific financial assets, or they can trigger major financial instability and spillover impacts into the economy. And, we're all conscious of the global financial crisis and how that played out very clearly in 2008 and 2009. And so on the basis of this potential, negative spillover effects, systemic risks are another justification for government intervention in financial markets through financial regulation. And I think increasingly, the economics community and financial regulators are aware that these systemic risks can also arise from outside financial markets too. It's not just financial institutions mispricing companies or other financial assets, but also major trend changes like those we're seeing through climate change and biodiversity loss that fundamentally change the performance of the economy and therefore affect financial performance. So stepping back from this, I think my original point was that sustainable finance sits on top of this existing body of theory. And we can understand it then as a set of investor behaviors and policy instruments, which are built on this view of information-driven rational markets, where the role of governments and regulators is primarily to address market failures arising from these information asymmetries and the low incentives to assess and deal with systemic financial risks. And based on this logic, the emerging sustainable finance policy architecture, including the architecture we're building here in Australia at the moment, seeks to ensure that financial institutions have access to and properly incorporate sustainability information to how they decide if and how to make investments into different financial assets. And so specifically, this includes policies like green taxonomies, which define whether certain assets are green or not green. It includes policies like disclosure regulation, which I mentioned before, requiring listed companies to disclose their greenhouse gas emissions profile or exposure to climate risks. We've obviously just had a piece of legislation passed last week in Australia requiring large companies to make those types of disclosures. And the logic behind this standard set of policy measures is very closely calibrated to the theory that I just have been describing. It's about getting information into the hands of investors, and in doing so, the hope is, I guess the theory of change, to use that language, is that and I think Chris made this point earlier, right from the very beginning, the theory of change has been to get financial actors to exercise rational judgments based on this information and decide to buy and sell financial assets in a way that reduces their own financial risk exposure of climate change and other sustainability issues. And in doing so, introduce a price for emissions and other non-sustainable activity into the economy. And the hope is that this will have broader spillover impacts into the real economy. And I think the problem has been yeah, well, and I think that investors have been really trying to live out this theory of change, to try to use this flourishing sources of sustainability information in an attempt to genuinely try and achieve sustainability outcomes. So investors use this information to make decisions to divest from assets that are causing environmental and other forms of damage. Many are trying to reduce their exposure to sustainability risks through stewardship activities where they nudge company management to change their business models to be more sustainable. And in fact, in sort of widespread surveys of investors, this is something that they hope to do more of in coming years. So a PRI survey in 2022 showed that a majority of investors hope to move beyond collecting sustainability information and focusing more, and I quote, on real world sustainability outcomes in the coming years. The problem, however, is that to date, the peer-reviewed research that's looked at whether sustainable finance and all of these mechanisms are having much impact paints a pretty bleak picture of this kind of information-based theory of change. It's not yet delivering much by way of sustainability impact in the real economy. More money is going into green assets for sure, but lots of money is still going into environmentally damaging assets. So finance is not yet having that impact of bringing down greenhouse gas emissions, for example. And the problem here is that this is being seized upon by skeptics of sustainable finance, particularly right now in the US, to say that this approach is little more than greenwashing by liberal elites and should be rejected. So that's the real threat here. So I think it's sensible to ask at this point, how do we help the sustainable finance system deliver more sustainability outcomes and really focus on the outcomes question? And as you can probably tell from where I'm going with this, my central claim here is that we need to move beyond the deep faith that information delivered to financial actors is what's going to save us. And let me explain by highlighting three core issues with this existing information-based approach. The first is that many significant sustainability problems are driven by actors who reside entirely outside the four walls of the sustainable finance architecture that we've built. This limits the ability of sustainable finance to have meaningful impact right from the get-go. The regime itself is set up in a way that is limited from the start. So as I mentioned, sustainable finance, the core concepts were conceived of by inside actors, mostly from liberal market economies. And in this context, the focus was towards investor-owned companies trading on publicly listed markets in liberal market economies. But we know that some of the most important firms from a sustainability point of view exist outside of this world. So to give you an example related to climate change, state-owned enterprises, as opposed to investor-owned companies, dominate the global energy system. And these are companies that are owned wholly or in part by governments, as opposed to investors. And these firms matter a great deal for climate change. SOEs own more than 50% of global coal assets. They own most of the world's oil and gas reserves. They also dominate in electricity production, the largest single source of emissions currently. And to give you a sense of their climate importance, consider this fact. If we aggregated the emissions of every SOE in the world, their emissions would be greater than every other country except that of China. So there's really no path to reducing global greenhouse gas emissions in which SOEs are not central actors. But despite their importance to sustainability, the sustainable finance system has very limited interaction with these firms. to be fair, some SOEs do list stock on capital markets. Some do raise debt finance from private investors, but many sit completely outside the financial system. And this, as I said before, this limits the scope or the ability of sustainable finance right from the get-go. And I'll come back to how we might, tweak the boundaries of what sustainable finance is to better encompass these types of firms. So the second point, and it's related to the first, is that because some financial institutions are now subject to greater transparency because of the sustainable finance regime, there's now a incentive structure built into the financial markets to what I call risk shift. So to shift sustainability risks, but not necessarily to reduce those risks. So what do I mean by risk shifting? So here I'm talking about situations where you have a financial institution that collects and analyzes sustainability information related to one of its investments, realizing that that investment is exposed to a sustainability risk. The institution might try and change the behavior of the firm through stewardship. It might try to change the pricing of its financial assets. If it's a financial product, it might try to change the pricing of that product. But ultimately it might divest from an exposed financial asset. So to make this more concrete, you could consider coal mining in Australia. So the largest banks in Australia have now all restricted financing to thermal coal projects on the basis that they want to reduce their climate risk. And there's good reason for that. Coal's a major contributor to emissions and therefore climate risk. But all of the hard-won effort of sustainability teams within our major banks in Australia hasn't fully reduced climate risks of new coal. Instead, in this country, what we're seeing is that actors, again, outside of the sustainable finance system, like state-owned enterprise banks, large private unlisted companies, are coming in and investing in these projects and propping them up. So, not reducing the risk for anyone. And to be clear, banks are not doing anything wrong here. They're just responding sensibly to the sustainable finance system in which they're operating. The problem is that the system is set up in a way that encourages the banks to let their sustainability risks shift, in this case offshore, rather than encouraging them to reduce that risk. And why does this matter, this kind of risk shifting concept? Well, it matters because we're starting to see this happen across the financial system, in insurance markets, where premiums are increasing as a consequence of climate risk, or the availability of insurance is being decreased. We're starting to see it in mortgage lending, sovereign debt financing, and many other parts of the financial system, this kind of risk shifting as a consequence of sustainability risks. And this is a problem because often where the risk is shifted to is to those in the public sector or to communities, often to groups that have the least access to sustainability information, and in some cases, the least ability to do much about the problem. So the third and final reason why I think this informational approach, why we need to look beyond the informational approach is that it's structural barriers, not just inadequate information, that's oftentimes preventing investors from having a sustainability impact. So let me unpack that point a little bit. So that the information-based approach that I described to you before is primarily focused on managing financial risks. But if investors want to achieve sustainability outcomes, they need to do more than just avoid risks. They need to make investments. They need to make more green investments. They need to collaborate with others, with their peers, to change company behaviors, to encourage policy reform. And they likely need to be enabled to take on more risks to invest in some cases, new emerging technologies. And at the present time, the way that economies like ours govern financial institutions, the duties they impose on trustees, on company directors, the ways that laws regulate market competition, the approach taken to regulating some financial institutions. In each of these areas, there are perverse incentives for green investment. And in my view, this isn't being adequately picked up in sustainable finance policy making. You could pick any number of examples here, but let's just pick on superannuation. But Australia has a $3.5 trillion superannuation system, so a lot of potential to make a contribution to the global pool of private climate finance. But in our research, we're finding that one of the main reasons why more of this money isn't going into a net zero related investment is that the rules governing them create all sorts of perverse incentives to avoid these types of investments. To be fair, the Australian government's sustainable finance strategy is starting to consider one dimension of how superannuation fund regulation is affecting green investment, but there are a range of structural issues in play and across a range of different financial institutions that ought to be addressed. So main point here is that it's not just information problems, but the rules of the game that this is the very issue that the founders of ESG and sustainable finance were uncomfortable touching, I think are now one area that we need to really bring into much sharper focus. So I've laid out a lot of problems, and I'll use whatever limited time I have left to offer a couple of modest, I guess, ideas on where we could go. And I'll focus just on Australia, but I think some of these broader points have application to other markets as well. So, the first point is that I think we need to reorientate sustainable finance policy so that it's not primarily focused on correcting information-based failures in financial markets, but it's instead focused on how government can be what I call a systemic enabler between the financial system and the real economy. And I use this term systemic enabler quite deliberately here. This is a concept I've taken from environmental science, which refers to actors which bridge two different domains of activity. So for example, it's often used to refer to the way that ecosystem services such as water provisioning or nutrient flows can connect social and economic needs on the one hand, as well as ecosystem and planetary needs on the other. So ecosystem services sit in the middle as the kind of systemic enabler. And in the sustainable finance context, I like this metaphor, and I think there's an opportunity for government to think of its role as a systemic enabler in this context that might focus on how to use the regulatory and institutions of government more holistically to link the financial system to the real economy. Some of this is already happening through efforts such as the Net Zero Economic Authority, the Net Zero Pathways published by the Climate Change Authority in the last couple of weeks. But I think a more comprehensive approach is really needed here. And practically this might see initiatives like our Sovereign Wealth Fund, the Future Fund, working more closely together with large institutional capital to share risks in a way that might accelerate private financing of net zero transition. On the risk management side too, this might involve policies which bring financial institutions together with communities to work on ways of minimizing this risk shifting that I was talking about earlier. Again, there's some good work that's happening here. The Hazard Insurance Partnership, which is a Commonwealth initiative, which is trying to link insurers and communities in a way that allows them to manage climate risks without unduly reducing insurance coverage in climate-prone areas, is a really good example of this. But I think there's, again, scope for this to be expanded to other consumer-facing financial products, such as mortgages. A policy approach like this would also see Australian governments leveraging the relationships they have in an international context. So to get back to the state-owned enterprise point, Chris is a former ambassador of the OECD, and so let me just use the example of the OECD as one strategic relationship which we could leverage more effectively to ensure that entities like state-owned enterprises, state-owned banks, unlisted financiers in the region are encouraged to take up some of the same sustainability mandates that are happening within the sustainable finance system to reduce this risk shifting. So all the effort of the big banks and other financial actors in Australia isn't just lost to offshore investors. And the second reform suggestion would be this point I've been making about structural reform. I think engaging with that more fully and better aligning financial institutions with the sustainability goals that we as a country have already agreed to and that financial institutions themselves have already agreed to. So when Australia signed up to the Paris Agreement in 2015, we signed up to Article 2.1c of that agreement, which is an obligation to make finance flows consistent with the terms of the Paris Agreement. And as we've discussed earlier, one of the key issues there is addressing these structural barriers which undermine consistent finance flows. So I think a really tangible first step here would be to have a quasi-independent group like the Australian Law Reform Commission or even a parliamentary committee consider whether the incumbent regulatory regimes that we have in the financial sector are enabling our ability to meet 2.1c, a commitment that we've already signed up to as a nation. So these recommendations, which emphasize a role for government coordination and structural reform of financial institutions, clearly move beyond the somewhat narrow traditional foundations of, in the economic theory I went through earlier. They sort of imagine a larger role for government, not in a way that, it involves governments setting prices, but in a way that allows governments to work hand in glove with financial markets. And I would argue that these economic orthodoxies are changing very quickly, both in practice and in the kind of economics community. And we're seeing, major government intervention in markets as a way to stimulate the net zero transition in the US and in Europe, here in Australia. And in this context, I think it's important that the way we regulate and think about sustainable finance adjusts with these changes. And in any event, these reforms are needed because the stakes are now way too high to ignore them. It's now patently obvious that we're in the midst of sustainability crises of our own making, which were only going to get worse. And so there's really never been a greater need for capital at scale to help respond to these issues. And unfortunately, I think the headline takeaway from this is that the sustainable finance system that we have at the moment, in my view, is driving financial institutions to carry out a lot of busy work, creating and disseminating information at significantly increasing systems cost. And while this is a really important first step, I think the evidence suggests that it's not having the impacts that we're hoping it does in the real economy. And this really places the sustainability of sustainable finance at risk of backlash from financiers, politicians, and the public. And if that takes root, it'll push achieving the sustainable part of sustainable finance even further out of reach. Thanks.
Thanks very much, Arj, and I'm sure that you can appreciate from that presentation that there is a lot of thought and depth that's gone into this work, well beyond what Arj can share with us tonight. But join me in thanking him again for that terrific keynote. And some, I think, terrific takeaways from that are, that these issues are structural, that the approach of information alone or markets alone is not going to be sufficient, that these things are necessary levers, but not on their own sufficient, and that perhaps we've been building some things on shaky ground or shaky assumptions with good intentions, But it's time to perhaps call things as they are. And I love this concept of systemic enablers, and it's something I'm sure that we can pick up in further discussions. We do have time for a couple of questions. I know we said we'd finish at 6:30. If there are people who need to leave, feel free. But if people have questions, I was happy to take them. And we do have some microphones to ensure that gets captured on the recording. One here just behind. Thanks, Ash. Do you want to come back up?
Thank you for the remarks. You mentioned the next upcoming COP is kind of the finance COP. I'm curious on your perspective on what would be an ideal outcome of the finance COP, and then what's maybe a likely outcome from the finance COP.
It's a very dangerous thing speculating on COPs and COP outcomes. I think one thing is probably assured, given the history of COPs, is that you should temper your expectations. But I think there is, the reason it's called the finance COP is because there is an agenda item discussing a new finance goal, from I think where we are right at the moment, it would be really difficult to speculate where that might land. The basic contours of it is about expanding the overall quantum. So it used to be that the COP process had this $100 billion commitment. And the idea is to expand that quite substantially, because as I mentioned in my remarks, we now know that the overall amounts of money needed are much greater than 100 billion. And to also expand the sources, so it's not just coming from public sources. And so that's partly why, we're having this event, and there's lots of people thinking about this issue, because I think connecting private finance more effectively into the kind of climate architecture has been a big hope. I mean, I think there's a lot of hope resting on that because of the large size and scale of the private capital markets. But it's a tricky road. And I think hopefully I illustrated some of why that is in the discussion.
Thanks for the question. Any other questions? Got one here in the middle, and then we've got one up the back as well.
How do we ensure that finance is prioritised into the right places? So not all green investments are going to be made equal. So there are things that need to be done immediately, and there are things that can wait a little bit longer. What's the mechanism that might help to support that particular challenge?
Yeah, it's a great question, and I think this is I didn't probably have enough time to go through all of the nuanced detail, but one of the things I mentioned in passing was that the climate change authorities produce these net zero pathways, and I think one of the real advantages of having a government authority producing a pathway is that it allows financial institutions to prioritize if they care about outcomes. So I think having more open, so this is actually a place where I think information can be quite useful. Having more open information about what we need to do in a kind of national sense to achieve net zero, and making that available for investors, policymakers and others, and advocates, I guess, to hold those people to account, can be really useful. The obvious thing would be to say, well, government should set out a sort of a priority list, but I think there are a lot of sort of potential problems with that. One approach that I think is working quite effectively in the US and that we're trying to do here is that the government is kind of leading investment through, in the US case, the IRA, and that's crowding in a lot of private money. So I think, more open information and, proactive government investment is what I'd say.
I think we have time for 2 more questions. There's one here in the middle, and Catherine had a question after that. And then I encourage people to, that will be here for a little while to answer other questions.
Thanks, Arj. I was wondering, you were talking about how there's this hazard insurance partnership, and you mentioned that maybe similar measures should be extended to mortgages. I know recently they were talking about preserving, the government's right to intervene with RBA interest rates. From your point of view, do you see more intervention in things like interest rates by the government as something that would serve sustainable finance goals?
I'm struggling a little bit to see the connection. I mean, I'm not sure I know exactly what you're referring to in the kind of recent policy announcement or whatever that relates to interest rates. But sorry, do you want to?
I've been in Singapore for the last few days.
Oh, that's
yeah. I've been out of the news cycle a bit, yeah.
Debate in the last few days here in Australia where the suggestion was the government should be more interventionist with the Reserve Bank.
Oh, right. Okay. Yes. Yeah, I mean, I think that there is this like the kind of overall levers on the macroeconomy really, clearly affect the rate and scale of investment. I don't know that would go down very well, though, as a justification for enabling, more government intervention in the kind of primary structures of how we do monetary policy in this country. Like, I think is probably a slightly broader set of considerations to take account of. Yeah, so I'll just stop at that.
And there's two more questions. Catherine had one up the back, and the gentleman in the black jumper there. It's DL.
Thanks so much. You mentioned the importance. Thank you. Thank you. You mentioned the importance of the systemic enabler. I like that term of attaching to the real economy and the difference. What do you think are the critical things that you would like to see happen to drive that?
Yeah, thanks, Catherine. It's a great question. I mean, I think that this fundamentally, this is, as I mentioned in the talk, this would be a challenging thing to do, and it would require a certain level of leadership to do it, because these kind of, I talked a lot about economic theory, and I did that deliberately because I think this is a really important constraint to policy making in this area. And the suggestions I put forward here are I'd say, relatively modest steps in a direction that's slightly different. And so I think the core thing that would be necessary to kind of affect them would be leadership. Your really strong leadership to be able to challenge some of these basic kind of assumptions about how the financial system should interact with the real economy and the role of government in that. I think the current government is demonstrating that it's been willing to challenge kind of economic orthodoxy in how it does some other parts of its climate policy. The Future Made in Australia. The green industrial policy was kind of a real no-go zone, I think, for a long time. So that's all to say, I think, well, as I mentioned in the talk, I think there are some pretty big changes to these kind of orthodoxies. And so with a little bit of leadership, I think this type of thing is possible.
Role of government is a huge topic that can perhaps ground a whole other conversation. And I once heard Andrew Barr, the Chief Minister of the ACT, describe government's role as best served as being a facilitator and aggregator of resources. And I think that is a good place to start sometimes with these things. We'll take one more question. The gentleman here in the middle had a question.
Hi, thank you for your talk. I just had one thing that crossed my mind on problem shifting. So sustainability interventions, over a period of time, the problem shifts and would have unintended consequences. So would that have any impact on the financial flows?
So I think I'm not sure I fully understand the problem. What problem is shifting?
So you, for example, you clean up the ocean, and in the process you impact the noise levels underneath. And so the problem shifts now to tackling that problem. So the financial flows were targeted at the first intervention, and now there is another problem that's come up.
Yeah.
So
Yeah, I mean, I think this is a really important point. I think where it manifests, I mean, we're seeing it already in the net zero transition, for example, where we've taken, we know we're facing a lot of different sustainability challenges. We've focused a lot on climate change. And in the net zero transition, if you think about the energy sector, for instance, we're building lots of renewables, and that's now showing up in problem shifting, to use your term, in other sustainability areas. So it's affecting biodiversity, and that's a really significant issue to the ongoing transition. But I think where that manifests in the financial system is in how financial institutions think more systematically about sustainability risks. So at the moment, financial institutions are geared and they have the tools to think about one set of, sustainability risks or another. So they can think about climate change, but getting better tools, better information on that. But we know that the climate crisis intersects with the nature and biodiversity crisis. And that's again, I spent a long time criticizing information, but I think that's actually another area where information is needed to ensure that this problem shifting doesn't happen.
And a great note to also pick up the theme from Arj's keynote around taking a more holistic view. We need to see the whole picture and the connections between the levers, positive, negative, intended, unintended, and try to shift the whole system more away from creating harm towards benefit and contributing solutions that can scale. Please join me in thanking Chris and Arj again for I'd also like to thank again Melbourne Law School for hosting us, Melbourne Climate Futures, and the Academy for Social Sciences in Australia for making this event possible, and for their support also of early career researchers. I think that there are so many themes to pick up from tonight, and so I'm going to make a plug for another discussion where you can join us exploring these issues, facilitated by our colleague Dr. Donna Loveridge, with Tom Gosling from the London Business School and LSE in the next couple of weeks. And I think that also provides a nice metaphor for rounding out today's discussion, because on this question of the sustainability of sustainable finance, Tom Gosling and colleagues have written that if we think about it like a rocket ship in 3 parts, stage 1 of the rocket is working at least to some degree, and stage 2 of the rocket is a bit temperamental at the moment and frequently misfires, sometimes causing the rocket to fall back to Earth, and that stage 3 launches still remain the subject of rumoured sightings. However, we can take from that the fact that this is work for all of us to do. As Mark Carney said, it requires the whole economy to take us to the transition that we need. And so that means looking beyond the rocket itself, and systemic enablement, I think, in my view, involves making sure we have structurally sound launching pads, spacecraft that actually can reach and break through to escape velocity from the very powerful pull of business as usual and the incentives that are wired into our system. We need to train pilots and navigators who are capable of gaining meaningful insight from the information that's available. We can't just plug in the information and expect the rocket ship's going to take us where we want to go. We need to use it to course correct and to get better and better information to help shape the way forward. Because a rocket, to reach its destination, like when the generations before us took up the original challenge of space exploration, we're going to need to draw on some things we know already, and we're going to invent new ways of doing things. They drew on techniques from the air and the sea, and they invented new science of space navigation, recognising the scale of the challenge called for even greater focus and greater rigour. That's the task in front of us to make a priority. Thank you for your interest and for coming along to here tonight. Join me in congratulating Arj one final time.